Well, there's a lot of questions there. I think that we're having a spreading recession globally. I think it's already started in the UK and Germany and Hong Kong. China's cooled off dramatically. And although the U.S. is largely a closed economy, it's not totally closed, and it's not an island of prosperity to its own. So there's going to be lagged effects here from the rest of the world on exports, and you're seeing it in manufacturing. Industrial manufacturing production in the United States is down at a 2% annual rate so far this year. We saw the negative CapEx print on the second quarter, and housing is really, you saw with the new home sales today, even with lower interest rates, housing is not going anywhere. What's keeping the glue together, as you said, is the U.S. consumer. There's no doubt about it. The U.S. consumer has shown up, but will continue to show up, because the one statistic that has me a little unnerved is what's happening with real average weekly earnings out of the payroll report. Year over year, it's down to plus 0.8%. We're almost at stagnation on real work-based incomes. And the question will be, will the consumer adjust to that at a time when all these other components are already starting to contract? So, nothing here in the past couple of weeks or past couple of months has changed my view that we are either on track towards a classic NBER defined recession, or something very close to that that's going to widen the output gap, cause deflationary pressures to come into the system. And either way, no matter whether the Fed does 25 or 50 in the next meeting, the path is going to be towards zero over the next 12 months as far as I'm concerned.
And then on the earnings side, Nancy, you mentioned this is all, margin, it could compress margins, hurt corporate confidence. If you look at where the pain is today, it's pretty widespread. But technology down 3%, hardest hit group, energy, consumer discretionary. Which groups get downgraded the most in terms of earnings expectations as the trade war just gets worse and more prolonged?
Yeah, so David brings up a good point about the consumer, but I actually think they're in great shape. So the consumer discretionary stocks may actually be one of the places where you can hide, though you have to be selective. In this environment, I worry about the chip stocks, the transportation stocks, and overall industrials, because if the slowdown gets worse and impacts the U.S. more, then those are the companies that are going to be most exposed to earnings.
So it's the classic
declines.
China trade playbook.
It is. Yeah.